think we can start with our monthly market outlook and portfolio update call. Today we have Mr. Hitesh Arora. He's our fund manager for Abackus portfolios. Sir, you can start with the market outlook and then we can take it forward for the Q&A. Thank you.
Thanks, Shailesh. Thanks. Good evening, everybody. Welcome to the call. So it's been quite an eventful month, and a lot of things are quite topical in the back of, I'm sure, in the back of everybody's mind. So yeah, we'll discuss those and talk about our portfolios as well. So just as a quick recap of how what's been the performance of global and regional indices for comparison purposes. Past few months, if I may say, or a past quarter, the performance of the Indian indices has been rather flat. While we know over a longer period of time, essentially, say a 3-year horizon or post-COVID, we've done extremely well, which is also shown in the 3-year CAGRs of the Nifty small cap indices here, or the Nifty mid cap, or the Nifty 50 indices here. While over a 3-year period, we've done significantly well. One recent performance has been a bit lackluster. While if you look at some of the global indices have done exceedingly well over the 1 to 3 year time frame, especially their near-term performance has been significantly stronger, while India has been a bit lackluster. So I think we just quickly jump on to what has been, what's been back of everybody's minds has been. So there have been two events that have happened. The tariff talk has been going on for a long time. It's been going on since Feb, actually, when the market initially saw a sharp negative reaction. For the good or the bad part, the numbers have finally come, and we're looking at a tariff number of base tariff of 25% tariffs, but to everybody's surprised, the Trump administration imposed additional 25% tariffs on account of India buying oil from Russia. So essentially, what we are staring at is 50% tariffs that have come into force. But there's been a lot of back and forth. There's been a lot of tweets that have been come from the Truth Social, the channel that President Trump uses. So a lot of been back and forth there. Initially, noise, and from the government officials as well. Initially, the commentary was quite aggressive when they were putting the additional 50%, the additional 25% tariff. But the tone seems now to be a little more reconciliatory. So let's see where we land. But it seems pretty certain that at least to us that the the additional 25% tariff should go away. But with the Trump government, never say never, irrespective. So just to give a sense of where we are in terms of tariffs and how does India compare with other countries. So we I guess we are somewhere in the middle. Only countries like and this is, I'm talking about this pre 25% additional tax that we have. Only countries like Bangladesh, Sri Lanka, China, or Brazil were higher, but now we are with this additional 25%. We are amongst the highest. We almost match Brazil in that sense. Which are the sectors that are majorly impacted? So majorly, that what we have impacted is, see, against our basket of exports to the US, there's a significant proportion, around 36-37% of the basket that has been exempted from the tariffs, which is something like the smartphone, telecom, pharma, organic chemicals, etc. So that is a set that has been exempted. The other bit is something called sectoral tariffs, which apply to all countries as is. So there's no differentiation as to from a country. It's more of a product specific thing. So something like an iron and steel, aluminum, copper, things like that, which forms around 8.8%. So you're roughly looking at 1/3 that is exempt. on 8%, we are on level playing field versus other exporters of such commodities, where we've been exempted and which are sort of is the balance number that is there, which roughly forms around, I think, 55% of the 88 odd billion dollar that we export to the US. And the bigger ones there are uh, textiles and apparel, gems, jewelry, and machineries and related equipment. So these are the bigger sectors that are impacted. For whatever reason, I think everybody is confident that this will not sustain. As I said, the 50% is doesn't sustain. We probably come down to a 25% level, irrespective. And there are various ways around it, where the government is negotiating quite hard with the government, with the U.S. State officials, with the U.S. trade officials, and the Minister of Commerce, Mr. Piyush Goyal, has said that hopefully we'll reach to a conclusion by November. So in the next 2 months, hopefully, that's the public statement from the Commerce Minister, that we should reach to a certain conclusion. Irrespective of that, I think the impact on the GDP by amongst various estimates is 0.3 to 0.4% of the GDP. The good part for India is our exports are roughly, are uh, we largely more of an inward looking economy, and of our total exports to the US of goods, not services, only goods, is around 20% of our total exports are to the US. So overall, base itself being lower, and only of which one fifth is exported, and within which only half of it is roughly where we have some sort of a discrimination in terms of higher tariffs. I think the overall question that we have, the overall impact that we have is rather low. Economists assess the impact to be around 30 to 40 bips of the GDP on a conservative basis. What does it mean for us as investors? So two things broadly. As investors, first the negative bit. It is a lot of it is a, comes with a lot of negative headline, right? This tariff war, India being in the news for sort of all these reasons, uh, takes away some sentiment of globally. So a lot of FI investors, which may not look into very much detail, but which may be more headline focused, which may be more macro focused, they may stay away or they may take out money. So that's a bit of the negative sentiment there. As domestic investors, what it means for us, uh, we can be choosy around which companies we want to invest in. We are more bottom up investors, where we see their earnings will not be impacted. We can we could be investing there where we think sectors will be potentially be impacted, and anyways those are smaller components of the overall market cap, and we can choose to ignore that. So that is what as investors we would like to do as domestic investors, bottom up investors. That's what we can do. So this is this bit on the tariffs. The other bit is the government is also proposing support packages for some of the affected sectors like textiles, but that's yet to be seen. Anyways, so I would not be too worried about it and would not read too much about it. Yeah, but for the sentiment aspect, of course. See, and the other thing which has been very topical is the GST 2.0 reforms. So, post COVID, the government has been focused on infrastructure, manufacturing, PLI schemes, and things like that. But consumption revival has now become among the top two priorities, among the top priorities of the government. We saw that during the budget earlier in the year, where the government, by way of reducing taxes, gave 1 lakh crore in terms of uh, to the consumer, to the Indian taxpayer. The reduction in taxes amounted to obviously about 1 lakh crores. So that was one measure that the government took. The second measure, which is effective 27 September, start of the festive season, where the GST rates are being rationalized, and we are moving from the initial previous 4 tier structure of 5, 12, 18, 28 to now a more streamlined, simplified structure of 5 and 18%. So that's the idea. The impact of this is about 48,000 crores as per the government estimates. So that's the reduction in taxes. Uh, so which are the categories that have been, significantly where taxes have come off quite sharply? I'll just, for the simplicity, I think I'm not sure if everybody could read it through, but for simplicity, consumer durables is one place where we've seen significant reduction. I'll just make it a little more simpler. Consumer durables is one place where we've seen a significant reduction. We've seen significant reduction in building materials, where for especially for cement, where tax rates have come off from 28 to 18%. We've seen very significant reduction in categories of consumer staples. So your day-to-day goods, whether it's butter, instant noodles, mineral water, the soap bar that you use, the shampoos that you use, the sugar, beauty products that we as a household uses on a day-to-day basis, those have significantly come off. In automobiles, again, we've seen significant reduction from 28 to 18%. Tractors going from 12 to 5%. Two-wheelers in the 360 category going from 28 to 18%. Again, three-wheelers coming off from 28 to 18%. PVs in the sub 4 meter category coming off from 28 to 18%. So significant reduction in on all consumption-driven items that that a household uses on a very regular basis. So one of the questions that obviously this has its benefits in terms of lower tax means higher demand. Higher demand translates into higher consumption. Higher consumption, the volumes that companies sell, and we are expecting around 200 to 300 basis points of overall volume increase by companies. So all this has a significant multiplier impact in the economy, either by way of simply by way of what is it, higher compliance, because the simplified structure, lower tax rates should lead to higher compliance. That's been a hypothesis that has been well tested. You'll see price reduction. Price reduction should. So what we've seen in terms of two things. What we've seen, if I can just step back, we've seen price reduction. So the GST rate cut leads to price reduction. So that increases your propensity to spend. The other bit is the lower tax rate gives more money in the hand of the consumer. So you've got on one side, you've got more money in your hands, and the other side, the goods and services that you are buying are at a lower cost. So it's the benefit is more than 1+1, and it's the multiplier is actually, if you look at it, it's 2.33. So both these measures, which is this lower income tax rates as well as a higher lower GST rates, should more than offset, I feel, should more than offset the revenue impact that the government has on foregoing the on account of the lower GST rates and the lower revenue collections that it has on account of these lower rates. So I think on that sense, I think we are pretty confident that that 6.5% to 7%, the GDP growth rate that has been forecasted, both these measures should help to sustain those levels and overall increase the consumption related component of the GDP that has been sort of slowing down, plateauing for a period of some time now on account of various reasons. So that is on those two topical things, which is the Trump tariffs related talk and the GST thing. Yeah, so just a quick one on the on the fiscal side. While we've touched, I think a lot of people would have the question in mind: does this lead to stop in capex spends for the fact that governments, uh, budgetary revenue receipts will not be met? We are of the opinion that this should not have impact, as the consumption spends related spend should more than offset the reduction in the collections. Also, the government can expand. I mean, the government's have been doing a very tight, walking very tightrope as far as the fiscal deficit trajectory or the glide way has been concerned. So the other thing is government can take some leeway of 20-30 bips should it wish. But as far as the government capex is concerned, I don't think so that should be a problem. But the good part here is the private capex that has been lagging for a while now. Higher consumption should also lead to higher capex by corporates, which have a very uh, clean balance sheet at this point in time. So that is something also we are looking at. There are also multiplier effects that expand to the financial services sector, where people are buying goods and probably use some part of the cost as a borrowing. So as I said, there are different multiplier effects in the economy that should aid different industries, leading to higher growth. Higher growth means higher profits. Higher profits also leads to better tax collections for the government. So yeah, the other thing that we've generally been talking about on a regular basis is the FII selling, and how are the FIIs versus the DII flows. So on a net basis, if you look, FIIs have been significant sellers this year. More so in the initial months of, I would say, Jan, Feb, and which were much more significant. I'm just talking about a calendar year basis. And while the pace has currently slowed down after an initial period of buying, uh, the two, three things associated with it is one was I think the skirmishes that we had with the neighbors of the India-Pakistan war, all these, and this whole Trump-related talk and the general geopolitical uncertainty that sometimes does keep the FIs away, because they are at some stage they are macro investors, and India valuations, after, as I said, after a steep run up, India had become slightly expensive, and there were relative other opportunities that these investors could invest in. So for them, it's always more relative. So that's been the story, at least this year. So FIIs so far have been net sellers, but what this amount actually pales compared to what the domestic institutional investors have been buying. So in domestic institutions, are we looking at a number of around 58 billion versus 13.6 billion, 58 billion of buying by the domestic institutional buyers versus 13.6 of the selling. Now, this of this 58, we are looking at only over the sort of the 8 months, we are looking at 38 billion by the mutual funds itself. So, which itself is quite a significant number. 58 billion also is a significant number if you look at the fact that we are only 8 months through the year, and while the last year's buying was 62 billion. So, the buying this year should be significantly higher, and the only concern is there is a significant supply of paper at these levels. So that is a bit of a concern from an investor's standpoint. But otherwise, I think well, I wouldn't read too much into the FII selling. Once some of these things stabilize, I think investors should come back very fast. I wouldn't read too much. Uh, so just on the just on some of the GDP trends, what we've been looking at. So India GDP grew at 7.4. The nominal number was at around more than 8.7, if I remember correctly. FY26 will be in the vicinity that we've been expected, around the 6.5, 6.6 number. I think that everybody's quite certain about. Uh, what drove the GDP was the significant capex that was done, the government-related expenditure that was done this year. We were off a low base last year, so that added significantly to the GDP numbers. Uh, for I what's happened? So I think just two things to keep in mind. One is I think people underestimate it are the fact that our oil prices are under control, which leads to a lower inflation and a lower spread of inflation across the economy. So that and which again leads to lower food prices, etc. So that has a multiplier effect on the economy. So that is something that has probably not been recently as much appreciated because oil prices have been benign for some period. So that is, I think, that's some credit to the government there for keeping the oil prices under control. So that's a significant. As I said, that has multiplier effects. The other is over a longer period of time, what we are looking at is growth rates of 6.5% plus for the Indian economy. And so our growth is in that vicinity, while the developed market economies are probably around 1 to 1.5, or in some instances actually not growing at all. So say 1.5% on average, maybe, or 1% on average. The diversion in the GDP growth rates has been significant, while India has a significant room to increase its, plus the fact that India has got significant room to increase the growth rates as well, by way of some of the policy measures that we've just discussed. So barring some external uncertainties where we've got little control, actually, I think the Indian economy is in a good stead. But just from policy measures, I think we've discussed in the past as well. There have been significant measures to increase liquidity in the system, credit growth in the system, all that. So just as the sort of afterthought of the fact that our inflation levels are lower, we could also be looking at another 25 bips of rate cut, probably not immediately, given the initial 50 bips rate cut was more front-ended. But I think the lower inflation does give a scope for increase of another 25 bips reduction in the repo rate. So that, yeah, and the RBI has taken enough measures for credit growth. They've reduced the risk weight for banks and loans to invest in microfinance companies. So yeah. And over a period of time, RBI has increased, as we've discussed previously as well, RBI has infused significantly liquidity via OMO measures, open market operations measures, rate cut, etc. So that has been in place. So from a policy standpoint, I think a lot has been done to induce liquidity in the growth, which should again spur credit growth in the economy, and the fact that because of these GST rate cuts, it's I think it's the combination of rate cuts, increased liquidity in the system. I think that should aid credit growth, which has been ailing in the recent times. So over a last base of around, I think in the previous years, we've touched 15, 16, 17% credit growth. But in the recent times, credit growth has been ailing, and both on the consumption side as well as corporate capex has been relatively low. So a combination of these three, four factors should aid credit growth in the economy as well. The Indian inflation remains under control. Bond yields, but I think they are under control. There have been some concerns on account of the fiscal deficit of the GST rate cut, but I would not read too much into that. And similarly, the crude prices, thanks to India and China buying from Russia, prices have been, oil prices have been also under control. So on that part of the sort of the macro setup, I think that bit looks good. Just moving on to what are the fair valuations for Indian markets, and I think that is a question obviously in everybody's mind. I think markets have been sidewards for a while. So we've seen despite some growth in earnings, some high single digit growth in earnings, markets essentially have been sidewards. So average 10-year average P, which was more closer to 19-20 times, has come off. If you look at say 2 quarters back, now has fallen to something like an 18 times multiple. So I think markets are slightly cheaper than their long-term average. So, which is in a way, it's a positive for because for the simple reason we've got some single-digit earnings, high single-digit earnings, but markets haven't gone anywhere. So, in that sense, things have become cheaper. ROEs, yeah, India's ROEs of Indian corporates are amongst the highest in the world. So, especially compared to China, so which is reflected here. Uh, just digging deeper in terms of how the sectoral valuations are. Um, Capital goods, again, some of these things had run up quite sharply and then they corrected since Feb, while historically higher compared to the historical averages, but the fact that there is a significant focus of the government on capex, etc. So obviously you'll see in terms of the growth runways, growth opportunities, the earnings and the earnings forecast, you'll see higher Ps there. Autos, yeah, are slightly just a tad bit expensive, but again, given the GST rate cut benefit, and one of the bigger beneficiary of the GST rate cuts, you'll find that sector to be slightly above mean, so that's okay. Uh, the important bit is banks as a sector, which is a significant portion of the market cap. The private banks are cheaper. So compared to a historical average of 2.5 1 year forward, we are significantly cheaper there. Again, credit growth in the economy should pick up, as I just said, both uh, private sector capex and as on the personal retail side as well. So, in that sense, we feel that, and the balance sheets are clean. NPAs are almost at an all-time low. So in that sense, we feel uh, we're comfortable with sort of private sector banks. The other bits are there. I'll not delve too much into the details here. Uh, but otherwise, from the other bits, GST collections, your UPI transactions, and all these things we've discussed even in the past. I think we are. I think we are good. There've been concerns around, as I said, the glide path is there. The government has maintained its glide path, and I don't see the government, wavering from it too much, irrespective, given how we've performed as. How the government has performed, and as well as the fact that its guidance has always been a little conservative. I think we have enough room to spend even on the capex side, and should not, uh, be too distant from the targets that we've set for us in terms of the fiscal deficit as a percent of the GDP. So the glide path essentially should maintain. It could be 10, 20 bips here or there, but overall, I think there's enough cushion in that sense. But again, just to important is to reiterate what is the central government capex as a percent of GDP. So before COVID, this number was significantly lower. We were roughly staring at around 1.7% of the GDP, but this number has significantly shot up, or more than doubled over the last few years. So this is something that I think again should be appreciated. The government is spending significant money on its side from the capex, so that has been a growth driver as well. Yes, as a country, we need significant investments in capex, and the government on its side is doing that. Plus, we've got the other bit is we've got the low base of last year, which has shown up in the GDP growth in the quarter as well. Yeah. Yeah. Overall, I think just to sort of recap, markets have been volatile, so there's no denying the fact. I think markets have been volatile. There's been sideways correction there, uh, but I think the important point is how we poised from here on, right? That is the important point. That's the important bit. Uh, I think because of this significant time correction, market is not frothy at all. I think in that sense we've got comfort. I mean, there may be certain pockets where where obviously valuations may be higher. So and some sectors obviously trade at higher valuations, but irrespective, the markets looks reasonable, and the longevity of corporate earnings, the India structural story is intact. Inflation is within the comfort zone, and so there is also scope to reduce rates by another 25 basis points. But that may be a little back-ended because the previous 50 bips was front-ended. So once the other important bit is we sitting on a low base of last year. So last year we saw significant slowdown in earnings due to various reasons, given high base of previous years, lower consumption, and which was seen in the impact thereon. So we've got and the fact that the Indian festive season on the back of all these rate cuts on the so the consumption demand is expected to be very strong. So in that sense, we are, I think, even in the near term, we are poised well, I think, and in the medium term, the structural story holds the India structural story holds intact. So both in the sort of the short term and in the medium term, I think we hold good. There are obviously uncertainties. For example, this tariff uncertainty, uh, this whole Russia-Ukraine thing. These are external factors, and these are external geopolitical events which do lead to volatility in the market. And obviously, one as a uh, investor, we don't really have a control on our side. But as far as or the government doesn't have a control really. But as far as domestically how we are placed, I think we are in good stead. Yeah, this is something I spoke about. I'll just quickly, spend 2 minutes on philosophy, and then just look at our portfolios, and then we'll open up to the for the Q&A. Uh, just to recap, and I'm sure all of you investors know it, but some people who are new to the call, as a fund house, we are very bottom-up investors. We very much focus on the numbers rather than forward-looking presentations, because ultimately returns are ultimately what about the earnings that come through. We are very close to feet on the ground. We visit factory floors. We've got a strong team of analysts where one or two of my colleagues are on the road visiting factories or plants. I was a colleague of mine, and I were in Gujarat the other day visiting a capital goods company. Another colleague of mine, she was visiting pharma companies in Bangalore. Another company of mine was visiting another solar cell manufacturing facility. So, very close to the ground, very bottom up driven research, very good relation connection, uh, and understanding of the management thought process as well. The second bit is, as I said, we are buy and hold investors. We're not momentum chasers. We only do it if and we don't copy and mimic portfolios. It's whatever we invest is our own bottom up thoughts that we deliver. We try to buy stocks that are cheaper than their intrinsic value. So over our holding period of say 3 to 5 years, we would ideally like to compound on account of both the earnings, so earnings accounting by say 15-20% or whatever be the number, plus the P re-rating, P being re-rated over this period of time as there is consistent delivery of earnings. So you gain on both sides, as the earnings compounding as well as the P re-rating. So that is that we are, and we've got a fundamental thought process in terms of the earnings, how we look at the framework and how we look at earnings. That's something very unique to Abacus. Ultimately, just a quick one, management quality. It's a lot of businesses are run by management, so they are very key to it, and the quality of the people that are running it and how they've delivered in the past what has been their capability, how they've treated minority investors, what are the return ratios that the business has generated, what is the quality. Second is what is the quality of the earnings? Is they more cyclical or more cyclical? I mean, say 1 quarter raw material benefit, or it's more structural in that sense. The other is events or trends by which just simplifying by an example. Uh, is there any risk to the business or the business model? For example, if I'm a car manufacturer or a two-wheeler manufacturer, can the a new EV technology disrupt my ICE engine business? So that's something I'd be wary of. Or if I'm a car battery manufacturer, can my is my business at risk due to the whole migration of vehicles to EVs, something like that. The other is timing. Timing, good company is not necessarily a good investment if the price is not right. If you're buying a stock that is extremely expensive at 70 times earnings multiple, while it only delivers, and it may be a very good business because there's a lot of certainty to those earnings. But if those earnings are only growing by 10-15%, uh, you risk derating of those higher multiples, and secondly, the stock can only compound as much. Beyond a point, uh, the upside risk is extremely limited. Yeah, the other is structural. Is the opportunity structural? Is the TAM for the business big enough? Is the small cap stock that we are holding, that small cap can become the next mid cap, or the mid cap that we are holding can become the next large cap? So things like that are in their mind. So in some of these things we've discussed, yeah, what we don't do, I think that's important. We don't chase momentum. We don't churn unnecessarily. Whatever we look is our own portfolios. It's bottom up research. Uh, we're not allocators. We are actual investors. uh, Credit risk, we don't like leverage for the fact that it limits the company's ability, uh, you know, to take risks to grow, and the fact that we are living in a very uncertain world, all these tariff situations, etc. So if you were levered and something like this situation comes, it limits your ability as a company to survive, especially if the uncertainty goes on for slightly longer period of time. Vis-a-vis, if you were not levered, your major expenses, you could still survive and probably come out stronger. But with the sword of leverage hanging around your head, it would be your survival itself would be, under question. So this is that, but I'll just quick uh, to move on to. So basically, we've got three approaches in our PMS strategies currently, which is the all cap approach, and these are the current holdings that we have in our portfolio, and this is the sector classification. That's the bar chart on the left. Uh, so yeah, just 5 seconds if you can just quickly go through it. And these are the uh, returns since inception and over different periods of time. So this is largely a strategy, a large cap and large mid cap kind of a strategy. Uh, so around 46% of the names are in the large cap space, and across large and mid, we are holding around 70% of the portfolio. So that's how the portfolio orientation is. So between large mid caps and the large cap stocks, we're around 70%, and some amount around 20% in small caps. So that is how the strategy is, and that's how and the table on the left gives the performance of the strategy. So the important bit is how is the portfolio valued, or what are the valuations of the portfolio? What are the expected, the P multiples, etc. So overall, I think we are, in terms of earnings growth rate, we are better. We are better. We should be seen better in terms of. So we are looking at close to 20% PAT growth, which is better than the sort of the underlying benchmarks. We don't like leverage, so that should also be uh, the portfolio should also be reflect that. So our leverage levels are pretty benign in that sense. ROEs are attractive, and PAT growth, as I said, including Orex financials, are reasonably attractive, especially in context of the valuation of the stocks that we hold. So yeah, that's the portfolio broadly how it is positioned at the all cap one. The other bit is the emerging. So this is just the emerging portfolio, top 10 names, sectoral allocations. Uh, so just to recap, it is more of a mid cap and a small cap heavy portfolio. So both across these names, we are looking at around 85% across mid and the small. The investment in the large cap names is relatively insignificant at, I think, about 7%. So it's more of a mid cap and a small cap portfolio, unlike the all cap fund. So again, this one here is compared to, all these things are relatively in the same range, in the sense that PAT growth is quite attractive, leverage is low to nil, ROEs are again quite attractive, valuations stack up against the earnings growth that we have. So yeah, I think so that's how the portfolio is positioned. The other one is the diversified alpha portfolio. So these are the holdings that we have in the portfolio. And the table on the left gives the sectoral allocations for the names that we have in the portfolio. This is a slightly differentiated approach. This was recent, something that we launched recently. Basically, what we have is a 40-30, sorry, what we have is a 40-30-20 approach, 20-10 approach, where 40% of the portfolio weight is towards large cap names, 30 towards uh, mid cap, 20 towards small, and 10 towards micro caps. So, overall, broadly as a 40 name portfolio, uh, of which 10 names are large cap with a 4% weight each. Mid caps, again, 10 names with 3% weight each. So that's 30%. Small caps, 10 names with 20%, for 2% weight, and then the micro caps. So broadly, this is it. And and that is how the also almost the portfolio weights look like, almost in that proportion. So 42% is large cap at this point in time, and 33 is mid cap, etc. Again, I think the fundamentals from a valuation standpoint, I think, again, it's similar metrics, lower leverage, good ROEs, PAT growth also expected strong, and valuations stack up against uh, the multiples that are of the respective names of the portfolio. So broadly, this is it. Yeah, I'll just uh, stop here, and we maybe we can just leave some time for the Q&A.
Hello.
Yes.
So the first question is more on the specific. So basically, do you see a blowback on any sectors as a payback for rollback of Trump tariffs?
uh, Rollback on some any sector. See, I think broadly it is whichever sector the earnings will be impacted. Those are that will be reflected in their uh, earnings will be reflected. Earnings will have an impact, which will again be reflected in their market caps, right? So that logic, as companies grow, their earnings increase, their market caps also increase in some correlation, right? Here again, you have some sectors that, as I discussed, fisheries, gems and jewelries, textiles, those are the sectors that have been impacted. And so those are the sectors that are very sensitive to the news flow around tariffs, right? for obvious reasons. So those are the sectors that will have an impact on earnings. So their valuations will be under cloud until this whole thing is not resolved, and if there is any, for example, some positive commentary, market reacts very positively, or if there's some negative commentary, market reacts in the other direction. So ultimately it boils down to the earnings of these sectors that I said that will be impacted by the tariff, and to that extent they'll be under cloud.
So next question. Post GST 2.0, any specific sector which Abacus is now focusing on, continue to focus on?
Yeah, so I think I can say two things really. So as I said, financials is something that we like. So higher consumption, should lead to, as I said, more money in the hands of consumers. Which again, some of it, as a consumer, if I were to buy a car and the car is cheaper and I've got more money in my hand, some of it I will borrow from the bank, and some I'll put it from my own pocket. So as a banks are beneficiaries of that, and obviously then more cars being sold, just as to simplify it a bit, more cars being sold, more capital expenditure being done in the place, more auto ancillaries being beneficial from that, so more capex being done. And some of it is on capex from your own balance sheet, some of it is borrowed. So hopefully, and we can extend that logic longer as well. So banks is one sort of place that we like, that is a beneficiary. The other is discretionary consumption. Discretionary consumption has been relatively strong, and uh, this bit should, obviously, the GST rate cut and all that is again, I think should help the sector. So that is also a sector that we like, which again benefits from this GST rationalization.
So next question is, what are your views on Nifty closing at 25,000 plus today, but the rupee has hit a fresh low of 88.44. Also, a bit of a dip in the gold, but can we expect this to go ahead? What can be the funds best given in the current scenario?
Yeah, I think yeah, the rupee has been depreciating because part of it due to these whole outflows thing. But just some bit on the the couple of things on the technical bit. Uh, the US is sort of slowing down a bit because of this whole tariff situation. So if rate cuts, if the US sees some rate cuts, and there's been a lot of noise, so some of that technical bit of the interest rate differential should lead to higher flows in the EM, and consequently the the currency should strengthen from here. The other bit is at this point, I think what is important is, at this point in time, the government actually doesn't uh, mind the currency depreciating as much. Uh, our inflation is under control, oil prices are under control, so all that bit is fine. So some of that can the government can take it, but to be a little more competitive from the export side, I think the government doesn't mind the currency depreciating. So that takes care of some of the tariff bit. So the 5-7% of the 25% gets adjusted here, and the seller takes a hit in terms of him probably improving his processes, cost control, and the balance bit the buyer takes. So currencies in some way is the support from the government. The depreciation in some way is the support from the government.
Okay. So the next question is, uh, when we can expect rise in earnings of our corporates?
No, I think that's a very good question. When can we rise? I think some Q2 may not be as strong because a lot of people may have pushed spending, because that rate cuts, prices will be cut, following the festive season. But the festive season is uh, will be quite strong. So you should see significant spending in the second half. Again, both this GST rate cut as well as the few quarters of the higher savings that would have come from the lower taxes. So both the multiplier effects thereof. So we should see strong earnings in the second half. Uh, for this reason, as well as the growth comes also from the relative basis that the base of the last year was lower, so we've got that added advantage as well. So H2 in that sense, I think looks good.
So next question is on has the government's focus from growth shifted from investment to consumption?
No, I think both will be under focus. I think that was one of the concerns of people that uh, will investment take a hit? I don't think so. That's not the it is just that initially capex was a focus and manufacturing was a focus, in which we saw in different schemes, etc. But now consumption also is a focus of the government. It doesn't mean that one may come at the cost of the other. We don't think so as a house. So you should have the benefits of both. The good part of it is with private consumption increasing, we should also see private capex increasing. So you get multiple levers of growth in the economy.
So going for next question is going forward, what's the view on our all cap strategy, all cap approach, PMS?
Yeah, I think all cap approach. See, just to give you context, the markets have did very strong over the past 2 years, and then earnings for and there was a bit of consolidation phase. Markets are never perfectly priced. They are overvalued, they are uh, undervalued, but rarely fairly valued for a longer period of time. So I think in that sense, that has also happened with the portfolios. The portfolio, uh, strong earnings, but after that a sideways move. But this has been last 1.5 year has been a portfolio for the portfolio as well, has been a period of consolidation. But the quality of the names is excellent. We feel they've got strong earnings potential. As I said, all the metrics sort of tick the box for the portfolio, and I see it. Last 6 months have been good. Uh, and we see the momentum sort of again continuing in the second half of the year as well. So overall, I think, as I said, 6 months should be good. Next 6 months as well, earnings in the portfolio should also be good. So plus the quality of the names is excellent, I think. So we have the portfolio is positioned very well, if I may say.
So view on gold and silver as China is continuously increase their reserves, so it may seem dollar dependency is strive out. What's your view?
Uh, No, yeah, but see, I don't, as a fund house, we look at fundamental equity, so don't have a very strong views on gold, honestly. We're more focused on this, so I'll not get into views in gold, I think. I'm sorry.
So view on IT sector.
Yeah, IT sector, I think on IT sector, we we like mid cap IT because the growth rates are higher there. On large caps, we are a bit neutralish on large caps. You'll not see many or hardly see any large cap name in the portfolios as well. So I think growth rates for single digit growth rates, and a lot of it also driven by currency depreciation rather than the on a constant currency basis, the revenue and the profit is growing. So the ability and vis-a-vis the multiples that they are trading at, I think there is very limited scope for re-rating or for earnings to compound. So we are better off looking at other names in the portfolios than look at IT. Yeah, mid cap IT names, I think where the growth opportunity is higher, we can look at it, but not too much on the large cap space.
So view on our emerging opportunity portfolio and mid and small cap.
Again, see, again, just in terms of the process and all that, I think we like the names that we're holding. They've been, for whatever reason, they've been, government sort of not. Uh, 1 or 2 quarters of has been weak for some of the names, or for some of the names they've had some negative reaction for reason beyond anybody's control, really. But I think the portfolio is positioned well. The quality of the names is good. Government spending is coming back, from which some of the names in the portfolio should benefit, and uh, hopefully with the lower uncertainty as well. Despite this uncertainty, the portfolio has done well, and as the some of the uncertainty reduces, the portfolio should do well. As I said, from the the growth metrics, the leverage, quality of the names, I think we are very comfortable.
The view on our diversified alpha strategy.
So this was this is something that we launched recently. Again, where we are comfortable with names, etc. We've put it. We've invested in those names and portfolio. I think, as I said, the quality of the names here again also is good. Uh, it's been such has been the nature of the markets last year. It has been sidewards. So the portfolio also did get impacted here. But I think it's a very unique sort of strategy, and over a longer period of time, I'm pretty confident that we should do well here as well.
Sir, any view on hospital, hotels, cement, pharma sector?
Uh, See, hotels, we have, as I said, it's a part of discretionary consumption. That's a space that we like. Uh, on cement, it is very region specific, so it's very difficult to have a call, and also the return ratios are so it's very region specific. It's very company sort of specific, so difficult to have a sectoral view as such. But I think the question in somebody's mind may be, will volume growth pick up because of the GST rate cut? Here, the demand is a bit inelastic, irrespective of the, unlike an autos and those kind of things, here the demand is a bit inelastic. It's more driven by other things like housing demand and all that. So more name by name basis. So it's difficult to have a sectoral view here, but I've addressed the point that the participant may have in mind. The other is, yeah, pharma as a sector. I think we like pharma. Where we get comfortable with valuations, we like. I think the growth runway is higher, while there's some noise around tariffs, etc. But there's uh, the most of the exports from India are generics, so they would not be. We're very confident that they should not be impacted. Enough logical reasoning for them not to tariff those low cost generics. Even in the CDMO space, we don't think there's a risk of tariffs, or the margins of players who do for the innovators, the margins are significantly quite high, so they can absorb those tariffs. So from the tariffs and situation, despite the noise there, we are comfortable, and the companies are doing great work. So it's more being, where you got more higher visibility of earnings and the valuations add up for you. It's more a question of that. But as a sector, we like that.
Sir, overall view on all our strategies, Abacus, all cap, emerging, and diversified alpha for next 1 to 3 years thought process.
No, I think it boils down to some of it is the macro. uh, as I said, it boils down to the global macro. It boils down to the some of the the this GST cuts, income tax cuts, those kind of things, and overall valuations, and fourthly as well, very importantly, the names in the portfolio. So all these, as I said, domestically, I think as an economy, we are well poised. Quality of the names is good. We've had a phase of certain time correction as well. So again, in that sense, we are positioned well for the portfolios to perform. And as I said, the quality of the earnings and the the quantum of the earnings should be is reasonably good. So all three factors we are good. There is a fourth factor of the global uncertainty. Unfortunately, there is little control that we have, and we can't be too worried about it. I mean, ultimately, we have to do our own day-to-day job. We can't be too much worried about these tariffs. Yeah, but obviously, to the extent that if this uncertainty attacks our impacts our portfolio companies, then we look at it differently. But the fourth factor is outside our control. The policy factor within the government, I think the government is doing a reasonably good job. Valuations are benign, and continue to focus on portfolio qualities, doing our fundamental research where we think we've done, where we built a reasonably good portfolio, and we'll continue to optimize and look for better opportunities if that obviously process that continues. Overall, I think I'm pretty confident for the next 1 or 2 years.
Okay. Uh, so I think due to time constraint, as we have receiving a lot of questions, but sir, any last comments on the markets and on the portfolios? Then we can conclude the call.
No, but I think it's just the last bit that I said. Uh, Things that we have under control, I think we are doing a reasonably good job. The good part is also that inflation is under control. So I think the impact of that should be appreciated. Uh, and I think overall, as an economy, we are one of the faster growing economies, and by compared to the other economies and the DMs of the world and other economies. So overall, as a country, we are positioned well. As a fund house, I think we continue to stick to our principles of fundamental research and being value conscious investors. So yeah, that gives me a lot of confidence that we should do a reasonably good job over the next 1 or 2 years.
Okay. Thank you all. Thank you all for participating and joining the call. Thank you. We'll meet you all again in next month. Thank you.
All investments are subject to market risks. Please read all scheme-related documents carefully before investing. Performance and references to returns are indicative and does not guarantee any returns. Investor discretion is advised. This video is neither a general offer nor solicitation to avail the service of investment from the CB registered intermediary under the services offered by Abakkus, nor is it an offer to sell or a generally solicit an offer to become an investor in the services offered by the Abakkus. The delivery of this video at any time does not imply that information herein is correct as of any time subsequent to its date. The contents of this video are provisional and may be subject to change.